So we'd like to thank everyone again for joining us. Just want to give a shout out to our sponsors here at Flyer. We're very thankful for everyone who has helped to continue to help build our community, and we're thankful for everyone who comes and joins us. Matt, are you on the line?
Yes, Jeremy. Jeremy,
Awesome.
I'm here.
Awesome. All right. I just want to remind everybody, we have a part 9. We're closing out of the year, December 17th. We ask all of you guys to join us. Everyone has been supporting us so well, and we really appreciate it. And we want to close the year out strong. So when you can, go ahead and register for part 9 of the Real Estate Direct Lending and Private Debt Forum. With that said, I'd like to introduce Matt Kiggins from Millennium Trust. Are you ready, Matt?
Yep, I'm good to go here.
All right.
Thank you, Jeremy. Thank you, Michael, for putting together such a great event. This is my 3rd time moderating here, and very much looking forward to it. So again, folks, my name is Matt Kiggins. I'm a Senior Vice President and Regional Director here at Millennium Trust Company. Those of you not familiar with Millennium, we are a $30 billion qualified custodian that's focused on the custody of alternative investments. We're headquartered just outside of Chicago in Oak Brook, Illinois. We provide services for both individual custody as well as private fund custody services, working with advisors that run their own private funds that are subject to complying with the SEC custody rule. We service about 1.5 million accounts, probably about 900 or so private funds. And from an individual custody perspective, we work with about 30,000 different unique funds in providing IRA custody services, allowing investors to invest into those different products. And from an overall regulatory perspective, we are regulated by the state of Illinois. I'm joined today by 4 esteemed panelists that will address current trends and market conditions in hospitality, multifamily, retail, and office real estate. Those panelists are Joseph DiMatteo, founder and president of JDM Capital; Tony Barkin, CEO and co-managing principal of Allagash Partners; Mike Mangione, director of family office and advisor relations of Group RMC USA; and Dr. Bharat Sangani, chairman of Encore Enterprises. So at this time, I'd welcome each of the panelists to provide a brief overview and introduction of their firm. Joseph, if you'd like to kind of kick things off.
Joseph's joining us. Can we start with Tony?
Sure.
Hi, thank you for joining us today. Matt, thanks for the introduction. I am the founder and CEO of Allagash Partners. We focus specifically on working class rental housing opportunities across the country, both in the form of individual investments in properties, as well as funds, private equity, real estate funds, both in the qualified opportunity zone fund methodology, as well as in the more standard opportunistic methodology. Our focus specifically, as I said, is on working class housing, primarily on buying underperforming properties in secondary markets in solid working class communities that have good growth potential, and then doing deep value add to those properties, bring them back to marketplace as solid, stable properties for the existing working class communities. We did this specifically because we think that it is one of the best ways to generate outsized returns in the marketplace while also being highly risk averse as a strategy, which we can talk about later.
Thank you, Tony. Appreciate the overview. Mike, are you on?
Yes. Can you hear me?
Yes.
Wonderful. Thanks a lot, Matt. And thanks for organizing this, and thanks for attending, everyone there. My name is Mike Mangione, director of Group RMC. We're essentially an old school family office co-investment group and now some institutions who get together and together we have the firepower to buy from very large institutions that are selling beautiful assets and acting like distressed sellers, complete custody and have life of their funds. So they made a promise 10 years ago and now they have to get out, and we've become liquidity providers to those guys. So we're some of the largest landlords in a handful of cities. We're the largest landlord in Kansas City. We're one of the largest landlords in Memphis, Columbus, Ohio, third largest suburban office landlords in Chicago. We have over 2,000 corporate tenants, including Microsoft, Oracle, Daewoo, PNC Bank, and all that. 18.5 million square feet and about $2 billion in assets.
Thank you, Mike. Appreciate the overview. Dr. Sangani.
Hey, good morning, everybody. Appreciate to be able to participate in this forum. Encore Enterprises was started in 1998, 1999, and initially primarily real estate company with multifamily, hospitality, mixed use retail and office. And we are primarily value-add, opportunistic kind of company. I always tell people that I'm looking for either a broken cellar or a broken physical plant or broken operation. And you have something like that, bring it to me and our company will fix it. We have done about 2 billion plus worth of transactions today. We own and operate about $1.2 billion of real estate, primarily owned 100% by us. Some of them are syndicated, and I'm sure we'll get more in the discussion of what is in vogue and what is making us sweat today very soon.
Thank you, Dr. Sangani. Joseph.
Hi, good morning, everyone. Joseph DiMatteo, Chief Executive Officer and founding partner of GDM Capital in New York. Our focus since 2004 has been on a broad spectrum of real estate. And over the past 6 years, we've been honing in specifically on hospitality investments, mainly here in the United States, select service and above hotels. We're currently in the process of aligning a new fund vehicle for us to look at some of the distressed opportunities that we see that are out there. We see the specialization needed for hospitality is very different than other assets because it's a real estate asset with a very refined business, operating business within it. So we're passionate about that area and highly skilled and be able to deliver results, whether it's opportunistic or value-added type transactions, but ready to navigate a very difficult waters that we see ahead as well.
Thank you, Joseph. Appreciate the overview. We'll plan to spend the remaining time here having a very interactive panel discussion. So I urge the audience to participate, submit questions through the Zoom feature. We will do our best to get to as many of those questions as we can. As we discuss the current trends and market conditions in hospitality, multifamily, retail, and office real estate, Joseph, can you kind of kick things off here and talk a little bit about why you focus on this particular strategy and why it can be compelling to investors?
Sure. So the uniqueness of this current market that we're in is that there's a broad brushstroke across every industry. There really isn't an industry that's been impacted, and one that definitely hasn't been as impacted is the travel industry. You've got restrictions across the world of countries, people able to be able to travel between countries, within states. And we see that as an opportunity to be able to look at our three-part kind of discipline of looking at basis first and analyzing that, and along with the discipline to be able to see what we look at to how can we achieve back to somewhere close to 2018, 2019 valuations, and what that cash flow path is to be able to achieve that. And this is achievable. We think that there are unique assets that are tarred with a very broad brush that may be momentarily impaired, but not long-term. And we see that there's a need for near-term liquidity, short-term liquidity for longer-term prospects of repair, and how we see what those costs are over a 24 to 36 month cycle, along with a disciplined approach to not go overboard in regard to what we see today's valuation, or looking at everything that's, X a key. Every $100,000 key deal is the best in the world. It's not. It's location. It's a derivative of the function of what that hotel or hospitality asset serves in that market. Is it a business hotel? Is it a travel hotel? Is it a resort? All those pieces come into play, and I think that it's not just every market, every asset. It's about the assets within that market to be selective enough. So we're not looking to do 500 hotels. We're looking to be able to be specialized to find the ones that are unique and can be repositioned on a rapid path with a definable amount of money being invested.
Understood. Appreciate that. Tony, your thoughts?
Sure. Actually, there's some significant follow-up or continuity with what was just talked about, which is that I think in this marketplace, our focus, and we started the company, just my partners and I, just a couple of years ago, specifically looking to be a niche player in a marketplace that we felt had tremendous value, and could offer that value with a lower risk. So to some extent, the current environment is to a great extent playing towards the strengths of the business that we've launched, which is currently there's the situation where being a good, solid, standard real estate investor can really pay off, which is to start with the value of the property, to start by looking at, and where is property value best right now? It's really in smaller, mid-sized assets in secondary markets, in stable communities. Those are the assets. And within that, if you look at it on a risk-adjusted basis, the multifamily marketplace is a particularly compelling place. We all know in general that home has never been more important. And that especially for working class communities, which have been hard hit by this pandemic and by the economic effects of the pandemic, it's really become an extremely important place. And renting their home is really their only option. So you've got this significant demand quotient, you've got an actual shortage in the supply, and that's what's really made it for us a very compelling opportunity, is to be able to focus on these assets, to be a niche, a smaller and newer player, so that we're not looking to invest billions and billions, but we can be extremely tactical and strategic about where we're approaching and how we're doing that. And I know we're going to talk about deal flow in a little bit, so I don't want to get too far into that. But that's really, we think right now that we're in a position where the strategy that we've chosen to be in, you never want to say the pandemic is a good thing, but it happens that the strategy fits very well within the opportunities that the pandemic is offering.
Yeah. Thank you, Tony. Mike, why is it that you decided to kind of focus on this particular strategy, and why is this compelling to your investors particularly?
Yeah, so Matt, we actually started off in multifamily in the 80s during the S&L crisis. And since then, our big chapter was in the 80s. We sold about 3,000 doors to Equity Residential, which is Samsdale's REIT. And then in the 90s, I'm from Montreal, and we almost had a referendum. So we actually pivoted towards office, where we found that's where the best deal was and the best value. You're getting the same kind of rents from doctors, lawyers, accountants who've been paying the rent for 20 years. And we like the fact that our rents were multi-year contractual obligations. And so you have contractual revenue across many, many years. So we kind of come accustomed to that. Now we do very large office space, but I guess not to quote the great Warren Buffett, but to kind of allude to what Tony and what Joe was saying, it's all about the basis. And it's hard to go wrong when you buy a dollar for less than $1. And the reality is, right now there's a dislocation because of COVID, where you're finding these very large opportunities, these huge institutionally owned assets, these office space buildings that are beautiful. Collection rates are 99% across in the last 9 months for the pandemic. The markets are growing, but because of this dislocation, you're finding them at exceptionally low values. And it's funny. It's like, pardon my vulgarity, but it's almost like a pissing contest right now between Pfizer and Moderna on who has the greatest success rate for their vaccine. And so this is a blip in time. And I think this decade's opportunity buying real estate. So we can buy some really attractive deals at a 10% cap rate and focus on that. To do that, you need to be super well capitalized. That's number one. You need to have a lot of cash. You need to buy a very low basis, and you need to negotiate your debt very well. Those are the three things you can actually control. Market dynamics, where the interest rates go, who becomes president, those things you can't control. But your cash basis, your cash reserves, your interest rate terms, those are things you control. You got to control them well. And I think if you're a strong player, this is the time to be making a lot of money. See, not to ramble off, one more thing. Too often, I hear, the fundamental, the most basic thing you learn in investments is buy low, sell high. But too often I'm seeing people buying high and trying to sell higher. Now is truly the time to be buying low and selling high.
Yeah. Thank you, Mike. Dr. Singani, your thoughts, sir?
Tony and Joe and Mike are specialized in individual sectors. I just dabble into all of them. And I'm just a doctor trying to do business. So I caution everybody to take my views with however they want to take it with. But I'm also very practical, I believe. So I'm not questioning anything else, but I'm just going to tell you what I see today. And with over the next few minutes, whenever we get into it, how to alleviate those issues. Some of those Mike just addressed, but hospitality right now is, for me, it's a very, very difficult sector, either to survive or to acquire or to build. We have a significant size portfolio, and we are actually doing better than the rest of the market. Our average occupancy is around 55% across the portfolio. And I'm still bleeding about $1 million a month that I'm cash funding the portfolio. The CMBS people have no mercy. And they've been calling our loans, and they're calling us to put down $5, $10, $15 million. And just like Mike said, if I didn't have the cash available, I probably would be on the street with those assets by now. There is very little debt available as far as I'm concerned. And I'm sure Joe can probably tell us a little more because he's more specialized than I am. But very little debt is available for hospitality. And of course, that eliminates development. So for all practical purposes, I'm for today. Now we'll talk about what happens after the vaccine comes and which sector is going to flourish the most. There's a different discussion. I'm just taking the cross-section as of today. So that's one. The second is multifamily. Multifamily has been the darling all along the time. Even during this pandemic, and we only do Class A multifamily. So we have seen our occupancies not dip at all, not even much. And our collections, we have less than 1.5% bad debt. We have about $350 to $400 million worth of multifamily development going on construction-wise. Luckily, construction was considered essential business, so it did not get affected during this pandemic. So we are going gung-ho. I don't see the construction cost coming down anymore. We just keep increasing the contingencies. So Class B and Class C has seen some reduction in the rent collection, and primarily because Tony just said it's a working class that got affected more than the C class, which is what Class A is. So multifamily is still doing robust. Most of the institutions think multifamily is a bond, which in my mind, it really is not, but that's how people feel, be as it may. And the office sector, to me, I shut down my office, and I used to have a 30,000 square feet office. And most people whom I know, they don't have office anymore, or they have office is very, very limited. The transactions are far and few in between. And unless you have a strategy like Mike, where, and I know Mike very well, is to buy, hold, and just wait for the right time. If you are like me, who has a time horizon of maximum 5 years, most of my deals are in and out between 3 to 4 years. This is a very, very tough situation for office. There is just, if I'm calling hospitality is a nightmare, office is probably double the nightmare, if you can call something like that.
Well, sorry, Mr. Sangani, it depends on the kind of office, right?
No. Of course. Listen, I'm just saying overall today's market. Today's, yeah. I'm not, as I said, I started the discussion by saying Joe, Tony, and Mike has a very different business models and they work. I'm just talking about lay people like me who has smaller sizes portfolios here or there, maybe a few $100 million here, a few $100 million here. I mean, you are the largest landlord in many cities in the United States. Hell, you can do anything. You're like Disney. You can create a destination place and people will still come. But I'm just talking about poor people like me.
Rich people.
So, but no, you're right. Yeah, you're 100%. I'm not trying to bash any sector. I'm just giving people the perspective that I have, which may or may not be correct. And that's why, and then the last piece is retail. Hell, I mean, where is retail? I mean, if Starwood can turn over the keys of multi-billion-dollar portfolio, and the Simon and other people get into this kind of situation, people like us have no place in retail. So that is my today's assessment of where the market is.
Thank you, Dr. Sangani. Appreciate that. Joseph, we'll throw the next one back to you. How is the current landscape affecting deal flow and creating opportunities in the market today?
So from a broad spectrum, to tail on some of the things that Dr. Sangani said, as well as the CMBS market is definitely fairly brutal. I can't, to a point of where it's just really not comprehensible to what their decisions are and how some of them can, it's just really very, very confusing to me in regard to what the ultimate destination and concept is when fiduciary responsibilities to the bondholders. So it's confusing in regard to seeing how this is panning out across multiple transactions that we've been seeing. I'm sure Dr. Sangani also can give some detail further on that as well. But from our side in the sectors, from commercial office side, we see that there is one bright line, two bright lines. One is that there's certain conversion opportunities of the right class, the right location that might exist, whether that be from commercial office to a hybrid, some hybrid products that we've been seeing, whether that's some part of it becoming a short-term stay model boutique wrapped around a traditional transient hotel. We've looked at some of the transactions in that manner. Just general comment on the office market. I think that the opportunities there are smaller office, boutique office, standalone office, where there is boutique, meaning the transient, people are utilizing it from that side, more of a hoteling concept towards office. But on the other side is where we're starting to see, if any conversations that we're seeing in the marketplace are for vertical control from companies. So if they're there and they have an ABC company and they're able to rent 5,000 and 15,000 square feet, ironically, as a standalone asset, which may have been a con. They want to be in the big, 40-story office building. Some of the smaller office is going to be part of where I think some transition retail goes to, and where some of those standalones might be absorbed, where there's less. And let's say the biggest edge of paranoia where companies have to worry, because we really have not seen the litigation side of this whole entire marketplace yet. That's so in its infantile circumstance. Which companies enforced mass took advantage when somebody happened to something. It's inevitable. And, we just don't know where that's going to land for that side. And I think that companies are looking at from being in that side saying, wait, I'd rather control the environment, know who's coming in, who's coming in and out, and what that looks like. And then from the side of hospitality, where we see the deal flow is really very early stage workouts. a lot of stuff that we definitely see touching on the CMBS world, which are complicated. And we see more traditional banks being very working along. This is not 08 and 09 where greed was good, and to the extent of where it caused all of this, over leverage, high leverage, bad underwriting, or underwriting concerns that might have happened. This is something that is completely out of anyone's individual's decision-making process, which caused these devaluations. So traditional banks have been, to their credit, really very flexible, to more so, I can't say every bank, but more so in regard to if it's a booked or a club deal that they're in charge of, to working along with the borrowers than basically, shoving them in the middle of the street. And I think that the deal flow that we're seeing is definitely problematic. There's a lot of half-baked construction that's out there that is going to be harder to be opportunistic on because of the lack of support, especially from the hospitality sector, on new development. There's no banks that come to mind that are throwing cash out. There might be a deal here and there that strategically or for a community purpose might want to be done, but there's not anything that's driving that supply. The excess supply is falling off because there's no demand behind it. So it's very difficult to look at development. The deals that are there, we see from our side, 75 keys to less than 300 keys is the magic sweet spot. Because with that, you're looking at it and saying my nightly rent roll has to be filled by 50 to 150 travelers, 200 travelers. You're not banking on, I need that 300 person wedding. I need this convention. The convention center hotels are really going to have a lot of trouble. We looked at a deal in Texas, 500 keys that basically traded for 32% of what it traded for 18 months ago. And it was 500 keys, and we looked at it as a hybrid redevelopment structure where some part of it would be furnished in service apartments, and the other part would be more of a transient kind of concept. But the trade on that was incredibly discounted. But there was a tremendous amount of capital needed to kind of do that. And that's where if you don't have any traditional debt support, the equity gets very expensive. So I think that that's where the market is pointing towards. It's, how big a problem you can solve with the capital that's required and the timeline that you're going to be able to turn that on. To look at something in 5, 8 year holds are not impossible to look at. I think that those are where the mindset has to be. I think the 18, 24 month turnaround, and puritanically, where you're, not absorbed of what's happened here. I think that's where turnaround may start, in 18 to 24 months, where you have a bottom out and then you have slow ticks, and a 24 to 36 month timeline after that, or plus in certain areas, where you're going to see a market recovery get close to that 18, 19, call that gross potential, and then you're discounting from that.
Thank you, Joseph. I appreciate it. Tony, your thoughts?
Sure. I guess just to address some of the things that Joe was talking about along the way, because I think they're important, is that I think right now, as we've all talked about, basis is absolutely the most important feature of any transaction, investment. Whether you currently have it, what is your basis? Where did you get in? And where can you own it as an operating entity? Or if you're looking at something new, what is it going to be? I think that we've always looked very simply at real estate. That has to be, as a result, we've never been in the hotter markets. We don't look at the Class A top tier markets because we don't think the basis really kind of ever gets there for that long-term opportunistic outsized return with moderate risk type of profile. Additionally, we also think that even as you get into smaller markets and smaller sizes, that it's somewhat unrealistic to look at 2 and 3 year turnarounds. I know that that's been the fad for institutional money. And especially right now, I think that that's just an unlikely scenario. I think that you really are in a situation, in general, we look at kind of 4 to 6 year investment profiles, or longer, to the extent that it's, for instance, in an opportunity zone fund where it would be a more extended profile. We think that real, that in real estate investing should be at its core, buy opportunistically, improve or develop intelligently, manage efficiently, and then sell strategically. If you do those things independent of whatever it is you do, you should be reasonably successful. And this is the time, the best time to do that. And the market does offer those opportunities. Again, if you're trying to invest $1 billion in 6 months or $10 billion in 2 years, that's a different type of problem to answer. And I think one that is not easily answered in today's world. But if you're trying to invest 20 million, 50 million, 100 million, 200 million over the course of 6 months or a year or 2 years, that's a very doable thing. There's still a significant amount of deal flow. For us personally, most of our deal flow is off market. We're approaching owners of properties whose properties are underperforming, where they are looking at their property, their assets, more as a cash cow that they've probably not strategic investors. They're treating them the way you treat a 175,000-mile car. They're just taking everything out, putting nothing in, and eventually they understand that that means it'll be worth very, very little. And that's okay for what they're trying to do. But we can go in this environment and show them a PV on that leads to a very low cost per unit. And that trade has been the one that we've been doing before. It's even more extreme today because people would like to get their cash out. They think there's going to be value. I don't know if they see that in the stock market, but maybe they do. Certainly the bond market, but maybe they see it in other assets. But we can offer that to investors, and there's more than enough deal flow for us to be opportunistic in that way. And that's our goal. You know, our goal is to find these really good opportunities that can provide anywhere from mid-teens to mid-20s net returns for investors over a reasonable time horizon. That's where we're going towards. And we think that this environment has made that somewhat more attractive, than previously. And the advantage of multifamily is that the government provides debt. And so there are private debt providers, but there's also the public debt providers in the agencies and in HUD. And so as a result, we've got the opportunity to do transactions that might be precluded in other sectors or might be very difficult to execute or highly risky because of the nature of the terms of the debt. Whereas we can actually still get extremely compelling debt terms for our asset class right now, which is a big advantage for transactions at these types of prices.
Right. Thank you, Tony.
Matt, just to tag one quick thing. The reasoning behind the protracted recovery is not the obvious, right? It's you have fiscal municipal issues, you have social issues, and you have fundamental issues of each asset. You have things like, New York City subways that, for example, that the ridership is crushingly down. And those are bonds that are supported for those expansions. And there's larger, municipalities that are going to have fiscal issues that are going to ripple through these investment decision-making models. There's a taint of an emerging market mentality that you need in regard to this. The money going into the municipality in safety, crime. I mean, you have to look at these and underwrite these factors towards every one of these asset classes. Everything that anyone wanted to go to New York for is gone, right? You want to go to the Broadway? Gone. Food? Gone. Culture? Gone. I mean, that's a long, out of San Francisco and New York are probably the two worst markets that we see. And I'm from New York. So, and thankfully, we haven't had outside of, let's say, in the metro area, we had Connecticut, but outside of that, we have not had that exposure to the direct CBD Manhattan in many years. So that's the extent of the largest worst case scenario. And if you work back from that in other markets that might have shorter term recovery or markets that are expanding, where you might see some of those time horizons be much more underwritable. But you've got multi-layer underwriting criteria that are impacting those decisions. And again, the reason I say that is to educate institutions. They, not that they are not to give it, but they need to understand from an operator's point of view yeah, you can have this beautiful office building you're buying for $50. I mean, back in the 90s, you know, I converted 866 3rd Avenue for, you know, it was $35 a foot, you know, into the Courtyard Marriott. So, you know, and $18 a foot for 10 Hanover. I mean, this is like a world that you may see again, and, you know, come back into this play. And what changed that was municipal support, tax credits, tax incentives. But when they're losing billions of dollars in taxes, how do they give any tax breaks? So there's a very violent spiral there that's happening.
Joe,
in the
Joe, what you're
background.
saying is funny. It's like a lot of seniors would say is, you know, people in their 80s, they'll say my latest car cost me more money than my first home. And so that's just the idea of, you know, buying in the 90s at $50 or $18 a square foot. That's an incredible basis to hold on to, you know. And and to your point as well on debt, just a fun fact for anyone interested, it's something that surprised me and took me aback as well. So I'm based in Montreal, but our head office is in the World Trade Center in New York. So I moved back and forth. And
by the way, for the record, Michael, I'm not 80. Just so you know. Maybe inside my soul might be an old soul, but I'm not 80 yet.
I'm actually 80 with a filter right now. You know, you can do that.
There you go.
You can add that filter. And what was interesting is that for the first time in my career, what I've seen, and people have careers longer than me, is that the spreads are actually smaller or more narrower in non-gateway markets. Like in Florida, where we're at right now, the spread is lower there from lenders than they are in New York City, which we have never seen. Usually it's because it's always no brainer the opposite. You know, there's less fundamental risk, more lenders competing against each other in New York. Now we're seeing lower spreads in non-gateway markets in Florida, for example, than New York, which we've never seen before. So just wanted to throw that out there. It's really interesting.
I was just going to say, to add on to what you guys have been talking about, is that what we haven't talked about is the demographic issues, which is, you know, we talk about the financial issues, the local financial issues, but I think that it's really important that people also consider what the demographic issues are. You know, I've heard commentators who've basically compared this pandemic to an accelerant, that basically all of the things that are happening are things that were happening, and people were discussing, they take 10 years, 20 years, 50 years, 100 years, what was going to be the timing. But we're seeing them now take, you know, months, some of these. And I think the demographic changes are really important, because that's going to impact the long-term capacity of these various municipalities to be attractive in general, both to investment as well as to living and to working. And I think that's where, at least from our standpoint, the overvaluation or at least the extreme tightness of cap rates across the board in the major markets, whether that's overvaluation or just tight valuation, that valuation in those major markets across asset classes has made them susceptible to these types of, to this acceleration of trend. And that's what we're seeing, is that a lot of the secondary markets that we're looking at, which were outperforming by by basis points, by 0.25% on a GDP, on a demographic basis, now have the potential to outperform by many percentage points potentially in the decade going forward. And I think that's both exciting for those places and potential to invest in those, and for people that are thinking about investing in it, and dangerous and worrisome for people that are invested or particularly continue to want to invest in what they perceive maybe is a widening and therefore an opportunity in some of the major markets.
I think you may be entering part of that world into a world of deflation before you see anything else, including wage deflation, which I don't think people are necessarily prepared for. And we've seen that even in the furloughs, especially even in certain hospitality sectors, and also corporately. I think that you're going to see some changes that are going to be happening from that middle management that they're maybe not prepared for. So as those jobs change over because of the virtual working, as people are doing now, the replacement of those positions are going to be I see 20 to 40% of where they were beforehand. So $100,000 job could be 60 grand in the next 12 to 18 months, because you're going to have the ability to replace those in different areas without the overhead, and it's going to be a better margin for those back office jobs and more offshoring.
I wish I was taping that for the conversation on B and C housing that we've got, because there's already an undersupply and have been a growing demand for working class housing in solid communities. And that's the argument for the demand becoming even greater, and the supply shortage becoming even more significant. And that, what's interesting is that people view that in terms of pricing. Well, that means you could raise rents. I'm not convinced that we're going to see massive rent inflation in the short term because of that. I think what we're going to see is extremely stable assets that have much more long-term value. And what we'll see, I think, is really the market for the assets start to compress. Whereas we can still buy assets at, 6, 7, 8, 9 caps, really, in some of these areas. And more importantly, on a per unit price, we can get invested at as much as a 70 or 80% discount to ground up development costs. I think when we wake up in 10 years or 12, that is going to be completely gone. I think that people will start to value these more stable, these smaller markets in a way that large scale investors haven't over the past 25 years.
Yeah. Thank you, folks. Dr. Sangani, any thoughts on how the current landscape is affecting deal flow at this point?
Yes, and that's a very good question. And whatever I'm saying doesn't apply to Joe, Tony, and Mike's companies. They're very unique, and in similar companies like that, they're very targeted, very well thought out planning. So that doesn't apply.
We love you too.
and I'm serious. There are other people have made lots of money and made lots of great investments during this time frame. What I'm talking about is the Robin Hood investors of real estate. People who have regular jobs someplace else, they're high net worth, they have some money to spend, and normally they would find some investment and they will invest in it. So please look at it in that perspective. I would invest in Mike, Tony, or Joe's company today any time if they allow me to, and I don't know if they're looking for money or not. But from my perspective, there is just not enough deal flow that makes sense today in my mind. We are raising less than 20% of what we normally raise. We have 850 investors in our company, and they want to put money in, and we just can't take money. We do not find deals that make sense. So we are less than 20% of our overall capital raise for the last 3 quarters. As far as the hospitality goes, we don't see any deal flow. That makes sense. 30 to 60% of all CMBS debt today are either in some kind of workout or they are under default. And there is no hope. You are hoping that the government is going to bail out the CMBS entire division of real estate. Nothing has happened. And the way the election is going, I don't know there's anything that's going to happen for a foreseeable future. And I'm talking about foreseeable in not the 80-year-old term. I'm talking about a few weeks or a few months. So I'm just giving my cross section again. From day one, from minute one, I've been saying I'm talking about today. So today, if you want to invest in hospitality, I would say run. If anybody wants to come to you asking you to invest, unless he truly can convince you that what they have is truly meaningful investment. I do not know of many hotels, maybe a far and few in between. And take all the luxury brands. They are all making money because rich people are still traveling. They're going to very exclusive places like Amman's or the 4 Points and blah, blah, blah. But people who just have a regular lifestyle, just like Joe was mentioning, Courtyards and Fairfields and Garden Inns and Hilton and all those people, they're all struggling. So I would say run from hospitality. There is literally no deal flow that makes sense in my mind for an average high net worth individual.
They could run to us. It's okay. They could.
That's exactly what I meant. They should go to very specialized people who can truly convince them. And then Tony said they can, and then that's perfectly fine. I'm talking about Robinhood investors, where you get immediate 10 emails and you say, okay, I'll invest one in here, right? So that's just not there. Office, again, Mike knows how to do office, but if anybody your next door neighbor wants to do an office deal with you, run. There are no takers today. There are literally no takers for office space. And then you're kidding yourself by saying, I will beat the world. So in my mind, I have no business in being in office space, unless it's somebody like Mike or that person has that situation. Retail, hell, I mean, I just talked about it. There is no point even talking about a deal flow. All the retails have been converted into mixed use or some other kind of last mile radius warehousing, this or that. Run from retail. There is no hope for a high net worth Robinhood investor. Multifamily, there is probably some juice here. Be careful. Just like Tony said, go to wherever you want to invest, think 10 times. Overall, if you ask me today, I would say, unless you are a gambler, if you are, and you do not mind taking risk and you are not going to lose sleep or investment, then all these sectors today, if I were you, I would just take a step back, only go with the people whom I absolutely trust, otherwise keep the money in the bank. I hate to say this, I'm a real estate guy, but to be honest, I have to be honest with you, and that's just how I feel today.
Yeah.
The finesse point, I would say, in hospitality, and that's why we talk about the key count, is where you can it's about 3-part process: getting to break even, stabilizing, and then making money. So when you look at the key counts that we look at and the brands that we look at, you can run the project more towards a break even at a 35 or 50% occupancy level more successfully than you can at 80 or 90 today, because you can't sustain the employment level and the expense level at a point where you could be able to find that break even point easily on 500 or 600 keys or 1,000 keys. When you look at something that's below that 250 to 175 is really a sweet spot. You can run and operate 75 to 120 keys and rotate them between your cleaning staff and be able to operationally finesse a break even much easier than you can in certain circumstances. But to Dr. Singani's point, if it's a Four Seasons and you have a 7-to-1 ratio that you have to maintain for the franchise, that even with all the money that rich people are traveling, you still could be toast. Mm-hmm. There's a finesse to it. That's why, a specialist is important in that particular asset more than most, I believe.
Yeah. Folks, we got about 15 minutes left. We've got 2 questions. The first one is on this same topic for Dr. Singani. The question was, how long do you think these conditions will persist?
Oh, that's a very good question. I'm glad somebody asked me, because all this negative stuff I'm talking about, I also want to talk about how positively I look at stuff. Listen, the best news is this is a temporary situation. This is not caused by an irate individual, irate society, or some stupid action by some country. And there is no foul play by anybody. This is a natural disaster, and I'm a lot more confident today than I was just a week ago. And being a physician, I can also have a little more credibility on the vaccine situation. In fact, I'm creating a video on vaccine that will go out very soon. But I think vaccine is the game changer. And I'm not telling anybody a new thing that nobody knows, but with 90 to 95% confidence level, that's huge. And if you're talking about just Pfizer putting 25 million dosages out, with 12.5 million dosages coming to the United States before the year end, and then 1.2 billion dosages just from one company over the next year, with majority or a significant portion of that coming to the United States, I do believe that by end of June, this country will be immunized. I do not know about the rest of the world, but I definitely know that the country we live in will be immunized by end of the second quarter. I do believe that there will be a huge upside for hospitality, clearly huge upside for multifamily starting the third quarter. I'm not sure as much about office and retail. Retail, I just don't know what's going to happen to retail. There's just too many factors playing a role in it. Office, we will have to figure this out. We will have to figure this out. What is WGH is going to do to us? And are we just too mesmerized that we will all work from home forever? Or are we going to relax? But it's not going to be a third quarter recovery. So I'm going to shut up at this point. If I have to sum up everything in one sentence, I foresee a third quarter recovery in 2021 in hospitality, further enhancement in 2000 in multifamily, possible recovery or some kind of reconstitution of office space. And I don't know anything about retail at this point.
I do want to address that in one way, which I think it's important to think about for investors, which is that it's going to be a tale of two cities. There's going to be, I don't think this is a broad brushstroke. I don't think we could treat this like a standard downturn in the economy, a cyclical downturn. This is an event. The event caused a set of behavioral changes. The behavioral changes, some will be, will be walked back. People will begin to travel again. They'll begin to go on vacation, and some won't. I think the demographic changes in where people live are not going to be walked back. I mean, the fact that I know many people who've moved from the Northeast to the Southeast. And they're not moving back because because we're coming out of this situation. So I think it's very important to think not only just about timing and just about the cycle changing or pricing changing. I think you have to be really strategic around the way in which you approach both the sector allocation into real estate, into what sector of real estate, but also within each sector, subsequently, where are you looking, or what are the areas, where are you investing? And again, this goes back, I think, addressing Dr. Sangani's discussion about the Robinhood investor, or I think that so many of the investments that people see are local, and I don't know that that's a good solution. I think they have to be able to step back and think, okay, if I'm seeing 99 opportunities that are local, one of them must be good. That may not actually be the case right now. That may be that it's important to go out and see if you're interested in the opportunities you're seeing locally, but you can't get those solutions, then you go out and find the solutions that are similar to those, but aren't local, but fit within the right strategic decision-making.
Yeah.
So, Tony, on that point, interesting fact that I didn't know LinkedIn did this, but they have a research group. And to your point, they're saying the 2020 migration trends, look at all the professionals. So we're employees moving based on their change of addresses. And this is super interesting. They said the biggest gains in net arrivals are places like Jacksonville, number one at 10.7% increase when you compare April to August 2020. Salt Lake City, Sacramento, Milwaukee, Kansas City are top 5. And the steepest declines in net arrivals, New York City, San Francisco, Bay Area, Seattle, Boston, and Portland. So that's exactly what you're saying. So I just thought I can send it to you if you'd like. I thought it was
pretty. And that fits exactly with if you think about the concentration of wealth and upper wealth and the concentration of Robinhood-esque, to use the phrase, type investors, they're often in the areas where you're seeing that exodus. And so those local opportunities, which historically have been, tagged Class A, shiny, new, attractive buildings, and they've been very attractive investments, even though they may not have offered the most compelling risk-return profiles, they've been really compelling for individual investors, for family offices. I think the world is different today. And I think it's important for people to start to change their investment behavior around that.
we've got about 9 minutes left. We've got a couple questions here in the queue. I'd like to see if we can get to them both, but the first one comes in from Elizabeth, who's in the audience. She says that she works for a restoration and roofing manufacturer that partners with green and solar options that provide lower costs to investors and PMs, but also add money to the bottom line. Do you see an increase in available spaces being transformed into more social spaces, ROI spaces, and using all the spaces you can?
So I'll take that because we are also just partnered with an energy company. So we did a investment in an energy company, primarily solar energy, but other energies too. And my viewpoint is that the credits, which was 30%, which is going to go down next year and then further go down year after. So the next year, the best use of the credits will be done. And I think again, we have a newer government. That government is much more, which I believe will be much more supportive of all this alternative energy. So I believe that, Elizabeth, your company should do well.
Thank you.
I would.
Yeah, no, go ahead, Joseph.
I just tail on to that the underwriting criteria that involves green factors for institutional investors is part of that ESG component, and I think that there's going to be an increasing need and availability for environmental and sustainable design, sustainable repurposing, as we look at whether it's commercial office being repositioned, hospitality assets to try to be able to create higher efficiencies, reducing longer term expenses. So I think that the ESG requirement, the concept of sustainability in solar and other energy reduction purposes are going to be critical. Though it may be momentarily, not on the hot list, it has been a compounding concern as an underwriting criteria for institutional investors and how you look at your ESG components, of which this obviously is a big piece of it. We've incorporated into our review of deals a very high review of ESG, sustainable design considerations, as well as trying to be able to find those opportunities within our pipeline. We plan on dedicating a definitive percentage of our new fund towards only making sure that those assets and that percentage fit the ESG requirements and look for green opportunities and things that obviously affect air and water are key components, as well as you look at even the environments where people are going to be working going forward. And the percentage of recycled air to the air that's coming from the outside is going to be a much bigger question in these design considerations and how quickly you can recycle that air. Where the traditional buildings have 10, 18, 15, maybe 20% outside air being brought in, it may take hours to recycle. So where you want to have a percentage, a higher percentage of people are going to be looking at that rateable ability to return as much fresh air components and designs. Foster Partners just came out with an amazing, unique design of how they've utilized it for offices, and it reduces cost, reduces energy, and increases, the turn of air. So people are not breathing in the same air on a consistent basis, which is obviously we see in today's environment with the pandemic, a very serious concern.
Thank you, Joseph. One other question, folks. We got about 5 minutes left. I want to make sure that we're able to address this. This came from Victor, who's in the audience. He's asking what kinds of yields are family offices expecting now, making 100 million plus investments. He says that he has about 3% family office yield and splitting 50, or I guess maybe splitting profits 50-50. So again, question coming back to what kind of yields are family offices expecting these days?
Well, I guess I can jump in here because we're a family office co-investment group. So we're about 400 or 500 different families. And I can tell you for a fact now, there's an incredible thirst for yield, and there's a lot of sensitivity towards any reduction of yield. And so people want to see the tangibility of receiving checks in the mail or those wires every quarter or every month, depending on the frequency of your payment. Personally, what we're looking for is anything where, you know, when we're buying 7 to 10% cap rate deals, you know, that's on in-place metrics. That's your yield before putting on a mortgage. So you're looking at 7 to 10%. Once you put on a mortgage, you know, you're closer to 10 or double, you know, a little bit higher in the double digits. And so remember that not all yield can be distributed, and people are very sensitive to the distributions. So you need to keep some of that yield for those cash reserves. You need to keep some of that yield to replenish your working capital reserves for CapEx and leasing brokering commissions and tenant improvement. You also need to keep some, you know, some money from that yield to pay down your debt reserves. And then you fall down to NOI. And from that, you decide, you know, pay your debt, pay your interest, pay your, you know, and then you decide what can I distribute. So I think people expect to have around, you said 3%. I would say, yeah, 3% is good, but I would say 5, even 7% net distributions coming out of your yield, or your, you know, this is after paying down your debt and after working capital reserves and after all that.
We've actually established a structure where we pass through all of the income, the net income, to investors, and we know we've back-ended our incentive fee entirely with a goal in a lower yield environment to providing investors with the highest actual cash flows that we can, especially, you know, in a situation where we're buying underperforming assets and then, you know, bringing them to kind of full utility over the course of 2 to 4 years. We want to maximize the cash flows at the short end as we can. And so, you know, we're not creating a share process, you know, in the standard carry interest format, but rather having back-ended our incentives specifically for that, for family offices. You know, I think that's right. You know, our discussions are, people are very sensitive towards that right now, and they want the highest possible yield they can in an environment where interest rates are low, where a lot of their general dividends, especially given the fact that corporate dividends or corporate profitability is being used for repurchases rather than dividends at this point in time, generally.
We're seeing some discussions slightly differently from our side, because maybe the nature of our asset class, and they're looking at it already as a different risk profile, and they're seeing the multiple driven decisions for us as primary purposes, and see this as an accompaniment to, let's say, a residential strategy, where they're looking for that yield, and that piece is they're looking for the appreciation, the pop, the sex appeal that hospitality has in regard to. That's why we attack things from such a lower basis and try to build back from there. So we're seeing our discussions, definitely them understanding, you know, the and needing the flexibility and driving value and trading the asset, and working off of that multiple basis from where you're buying it today.
Joseph, thank you. Tony, thank you. Mike, Dr. Sangani, appreciate it. I think we're up against the clock here. Thank you to all of our participants on the panel. Thank you for everyone that attended this session. Thank you very much for your time.
Thank you, everybody. Thank you for putting it together. Appreciate it.
Bye.
Thank you. Thank you, everybody. What a great panel. We appreciate everybody. We got to learn a lot about these thoughts on what's going on in the real estate market. We'd like to thank our sponsors again. Without you guys, we wouldn't be able to do this. You helped to make this a success, and we really appreciate you. Next month, we have Real Estate Direct Lending and Private Debt Forum Part 9 up December 17th. We ask all of you guys to join us again so we can close out the year strong. Again, we appreciate your support.